Today, I want to talk about how we're on the verge of triggering billions of dollars in forced selling, aka massive margin calls, and a wave of liquidations. I want to explain how derivatives have become so heavily over-leveraged that even small movements in the market are having a massive impact. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, Zero Hedge has posted about how Morgan Stanley quants are saying we're on the verge of triggering billions in forced selling. So this article starts while the hawkish Fed has shaken the market, an even bigger boogeyman lurks in the shadows, and the point of activating significant forced selling is getting much closer. So he starts by saying that while option dealers were net long $10 billion in Gamma just a few days ago, they're now net short in Gamma. And if you don't know what that means, he explains by saying that a one-day supply in a down 1% move for the S&P 500 would be roughly $7 billion lost for hedge funds, and in a 2% down move for the S&P 500, that would be roughly $18 billion. Basically saying that macro systemic strategies, which many hedge funds use, are at risk of bringing more supply if the sell-off deepens. And also added saying, in fact, a selling cascade that results in a 5% drop in the S&P 500 would unleash almost $180 billion in systematic selling. Morgan Stanley is basically saying if the market drops even a few percentage points, like 5%, that could result in an all-out crash, as these hedge funds and mutual funds would be forced to sell off massive chunks of their portfolio to rebalance. And Finance Lancelot has also posted this video, which I think is from George Gamon, saying the Bank of International Settlements has warned of a $1 quadrillion derivatives time bomb. Now obviously I'm not going to play this full 26-minute video for you, but I do think it's very interesting to see what the Bank of International Settlements has said. They've basically explained just how large the derivatives market is and how heavily over-leveraged that market is, saying that many of the major banks participating in these derivatives simply don't have the cash collateral to support the positions they're taking. And when you do have tremors in the market like in 2008 and in 2020, that's massively overdone because of just how heavily over-leveraged these derivatives are, and how they've become more heavily over-leveraged compared to 2020 and obviously compared to 2008 as well. Basically saying the next crash, even if it's a fairly light crash, will be massively over-exasperated and over-exaggerated and will likely end worse than 2008. It will basically turn, say, like a 5, 10, 15% crash into an all-out 30, 40, 50% crash.
Hello, fellow Rebel Capitalists. Hope you're well. So we just had this report come out from the BIS, and this is going to completely blow your mind. They've uncovered, or tried to uncover, how big this derivatives time bomb actually is. And in the title, I said it's a quadrillion. No. That's undershooting it by a long stretch. And when we go through this article, which we're going to do right now, they show you how much debt is off balance sheet in the shadows that we don't even know about. So when we talk about money getting tight or a lack of dollar liquidity, you have no idea about the powder keg that this actually, the size of the powder keg is unimaginable until you read this report from the BIS and understand that, whoa, what we are seeing just that's in the sunshine, this is just the tip of the iceberg.
As I said, I don't want to play this full 26-minute video for you, but I will leave it down in the description below if you are interested in reading further into what the Bank of International Settlements is saying. You can currently get a guaranteed free share of Tesla or of Google and up to 15 free shares on top of that, worth up to $2,000 each, which you could always use to buy more shares of AMC, GameStop or of any other stock. All you have to do is sign up to Moomoo using the link in the description below and make the required qualifying temporary deposit. Signing up to Moomoo is free and it's easy, it just requires that temporary deposit, but it's a really great way to help support my channel. On top of that, Moomoo is very easy to use. They've got tons of technical indicators and advanced charting tools and their own options trading platform. And Michael Gayed, the publisher of Lead Lag Report, is also saying we're on the verge of global margin calls. So it seems these margin calls aren't just going to impact the US, they're not just going to impact the UK, they're not just going to impact China, but it's going to be worldwide. But interestingly, even though we're on the verge of billions of dollars in forced selling and potentially global margin calls, institutions are still buying the dip on AMC. The French AMC ape has just posted the institutional data for AMC, and you can see, especially over the last quarter, institutions bought in massively. Even though the price of AMC fell significantly over the last month, these institutions still keep buying more. They haven't sold their positions they bought last year, actually, they've just added to them. But as he also adds, it's interesting these institutions are buying more when they're telling us to sell. As I've said, it's just shills being shills, trying to convince you or trying to beg you or trying to threaten you into selling your shares. Obviously, I can't advise you to buy or to sell or to hold or to do anything with your investments. You need to do your own research and make that decision for yourself. But Crystal POS has also pointed out something very, very interesting and potentially or most likely a major data glitch. So by now everyone knows that retail holds the float or holds the float multiple times over for AMC, but it seems Fintel has something else to say. Fintel is currently saying that institutions currently hold 97% of the AMC float. They're saying institutions hold 154 million shares, and we know the float is only like 160 or 190 with the extra 40 million sold. Maybe the institutional shares just haven't yet been updated, but it's pretty weird to see 97% institutional ownership when we know retail investors hold at least 90% of the float, if not multiple floats sold over. Now, Biotech Moose also had something very interesting to say about my video from yesterday. He replied saying, "Great video." He said it's not surprising Citadel uses intimidation. Other hedge funds like Balianzi refuse to even hire ex-Citadel employees. He said tainted employees who likely might be arrested for illegal work while they are at Citadel need not apply. It's actually really interesting that many other hedge funds decline to employ people that previously worked at Citadel. I thought Citadel only ever hired the best and brightest employees. Surely you should want to hire someone that's amazing at their job, unless of course they're previously affiliated with illegal crimes. So this article intro says Balianzi Asset Management has imposed a ban on hiring from rival hedge fund Citadel's global fixed income business. It says the investment firm told headhunters earlier this month not to recommend potential staff from the Citadel unit. As I said, why wouldn't you want to hire from an incredible firm like Citadel that only hires the best employees? Clearly, pretty much all hedge funds in the industry are wary of Citadel. Now, I also saw this comment directed at Adam Aaron, and these kind of comments really confuse me and really wind me up. Many shills ask Adam about the naked shorts, they ask about the blatant manipulation of our stock, and they ask about the multiple times spent on the threshold securities list, and they ask why does Adam Aaron never do anything about it. But then those same shills consistently also say the SEC is paid off. So if Adam Aaron doesn't run the market and if the SEC is paid off, how can Adam Aaron possibly do anything about the naked shorts, the manipulation, and the threshold securities list? All Adam Aaron can really do is raise it and file complaints to the SEC, to FINRA, to the DTCC, and to everybody else, and hope they actually do a proper investigation. Now, we've been told by the Department of Justice an investigation into short sellers is happening, but obviously over the last 2 years we've basically heard zero feedback from them. Whether this investigation is actually happening and they're just about to catch and imprison these short sellers, or if the Department of Justice and the SEC is actually paid off, how is Adam Aaron supposed to do anything about it? Obviously, the SEC say that when someone uses naked shorts or other manipulative practices to cheat the market and investors, the SEC will ensure they are held accountable. While that's something they say, what we've seen is obviously very different. I think it's one thing being upset with Adam Aaron for producing new revenue lines, for increasing AMC's revenue, for increasing AMC's profits, or for performing a reverse split if you're against it. But I think it's something completely separate being angry at Adam Aaron for the naked shorts and the manipulation, which Adam Aaron can't control. Adam Aaron is the CEO of a movie theatre company. He doesn't own the New York Stock Exchange, he doesn't own the Nasdaq, he doesn't own Wall Street, and he doesn't own and control Ken Griffin. I think it's really easy to spot a shill when they complain to Adam Aaron about naked shorting. If you want to complain about naked shorting, complain to the SEC, complain to Congress, complain to your local representatives, and complain to Wall Street, who are acting illegally. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.